There are so many types of investment products out there that it's completely normal to feel overwhelmed by the complexity of choosing the ideal ones. And that's exactly why I am here today. In this video, I'm going to explain how you can diversify your investment portfolio using bond ETFs. If you stumbled upon this video by chance, hi and welcome. My name is Natasha Villalobos, and here we delve into how to get financially organized. We cover everything from building a budget system that works for you to taking the first steps towards becoming an investor. So if you're interested in these topics, you're definitely in the right place. Now let's talk about why a bond ETF might be a good option for you. A bond ETF makes it easier for regular people like you and me to invest in the bond market. These ETFs are usually less risky compared to other types of investments, and you can buy or sell them easily just like stocks during the trading day. Plus, you don't need a lot of money to start. Unlike buying individual bonds, you can invest in a bond ETF with a smaller amount. Some places even let you start with just $1. This kind of investment could be perfect for someone who wants to diversify their investments and add less risky options to their portfolio. It's also ideal for those who have plans to use the money in short to medium term horizons. So if you're looking to balance your investment risk or need flexibility for future expenses, a bond ETF could be a great choice for you. But before we can understand how a bond ETF works, let's first clarify what a bond is. In simple terms, a bond is similar to a loan, but instead of you borrowing money, you are the one lending it. When you buy a bond, you're lending money to the entity that issued that bond, which could be the government, a municipality, or a company. And in return for lending them your money, they promise to pay you back the full amount on a specific date in the future, known as the bond's maturity date. You might also hear bonds being referred to as fixed income investments. And this name is because you usually know when you will get your money back and how much. Bonds can last for different times, some for just a few weeks, others for as long as 30 years, allowing you to pick the one that suits you best. But remember, bonds are usually safer than some other investments, but they're not 100% safe. Sometimes the organization or government that issued the bond might not be able to pay you back, and this is called defaulting. And the chance of this happening depends on who issued the bond. Think of it. Who is more likely to not pay back? A company, a city government, or a country's government? Additionally, bonds pay interest, also known as coupon. So while you are lending them your money, they agree to pay you a predetermined rate at regular intervals, which could be monthly, every 6 months, or annually until the bond matures. Now, an important aspect to understand about the interest rate you will receive is its relationship with the father of all rates, the Fed funds rate. The Fed funds rate is a critical tool in the economy. I'm sure you have heard of it. It's used to control inflation and influence interest rates for various types of loans, including bonds. Currently, as we can see in this chart, the Fed funds rate is the highest it has been in the last 20 or so years, sitting at 5.25% to 5.5%. The government raised interest rates to combat inflation, resulting in higher costs for those that are taking out loans. Therefore, when the Fed funds rate increases, borrowing money becomes more expensive. However, this also presents an opportunity for those lending money to earn higher returns on their investments. Conversely, if the Fed funds rate decreases, bond interest rates tend to follow suit. So recapitulating, bonds are popular for providing steady income through regular interest payments and are considered lower risk, especially government bonds. The next piece of the puzzle is understanding what an ETF or exchange traded fund actually is. Imagine it as a basket that lets you hold a variety of different investments all at once without the hassle of buying each one individually. This basket offers diversification, and this means that if one asset in the basket doesn't perform well, the others might compensate for it, helping you reduce your overall risk. But here's the interesting part: you're not in this alone. An ETF pulls together money from hundreds of investors, and this pool is managed by a professional fund manager who makes decisions about when to buy or to sell assets within the ETF, aiming to maximize returns for everyone involved. However, there is a cost associated with this service, and it's called the expense ratio. Now that we have covered the basics of what an individual bond is and what ETFs are, let's delve deeper into what a bond ETF is. To simplify, we will think of them in two main ways: the theme, what kinds of bonds they buy, and the duration, how long they keep them. On the theme side, you have got a big mix. Some bond ETFs buy bonds from governments, which are usually pretty safe and can range from national to local levels. Then you have got ETFs that buy bonds from companies, including big ones you have heard of to small ones that are just starting out. And if you want to go global, there are ETFs that buy bonds from countries and companies all over the world. And if you care about the planet and good business practices, there are ETFs that pick bonds from places that meet strict environmental, social, and governance criteria. Now, about the duration of the bonds in the ETFs. Some are in for a quick turnaround. They buy bonds that will pay back soon, and as those bonds mature, they swap them out for new ones that fall into the short-term frame. Others are more about the long haul, choosing bonds that take longer time to pay back, ranging from 10 to 30 years. Then there are some bond ETFs that have a finish line set for a certain year, say bonds that will mature in 2028, and all the bonds they own will finish up in the same year, and then the ETF wraps up and gives back the money invested. I know that theory can be boring and hard to understand, but bear with me because I have 3 examples to share with you. All 3 of them are bond ETFs managed by iShares, which focuses on US Treasury bonds. iShares is owned by BlackRock, which is the world's largest asset management company, with about $10 trillion in assets under its management, and all the information I will be providing can be found on their website. The first example is the IEI Bond ETF. IEI invests in US Treasury bonds with maturities between 3 and 7 years. This means that the ETF lends money to the US government, which agrees to pay it back within that time frame. Treasury bonds, which compose these funds, are considered one of the safest investments because they are backed by the US government. This makes IEI a relatively low-risk option for investors. What is the purpose of this ETF? It is designed for investors looking for a safe way to earn interest over the medium term. Unlike stocks, the price of IEI might not swing dramatically, making it a steadier investment choice. The yield, which is the interest income investors earn from the bonds, plus their potential gain or loss in price, is 4.12% as of the time of this recording. The expense ratio, which is the fee investors pay annually for owning the ETF, is 0.15% of the value of the investment. Now check this out. If you visit the iShares website, you will find a graph showing the growth of a hypothetical $10,000 investment in the IEI Bond ETF. This visual is helpful because it shows how the investment could grow over time based on past performance. So it's covering 6 months, 1, 3, 5, and 10 years. Its growth assumes that all dividends paid out by the ETF are reinvested, meaning that any interest income you earn from the bonds within this ETF isn't going to your pocket. Instead, it is being used to buy more shares of the ETF, helping your investment grow through compounding. And it's important to note that this graph is based on past data. It doesn't guarantee future results. The performance of the IEI ETF, like any investment, will continue to be influenced by market conditions, interest rate changes, and economic factors. Maybe you're asking yourself, do I have to keep this fund for 7 years? What happens if I sell it before? No, you don't have to keep it for 7 years. Unlike individual bonds that have a fixed maturity date when you get your money back, an ETF can be bought and sold at any time during trading hours on the stock exchange. The 3 to 7 years aspect refers to the maturities of the treasury bonds within the IEI portfolio, and it's not a required holding period for investors. However, the performance of bond ETFs can be influenced by interest rates movements. Here's the deal. Interest rates influence the amount of the bond's payments to you, those coupon payments that we spoke about. However, they also influence the price of the bond. When interest rates go up, the price of the bond falls because newer bonds with higher coupon payments will become more attractive to investors. Conversely, when interest rates go down, the price of existing bonds goes up because newer bonds will have lower coupon payments, making them less interesting to investors. So the way you could lose money is if you happen to sell your shares for less than what you paid for them. If you look at the graph that shows the changes in the price of this ETF, you will see that its highest price point was in 2020 and started declining in 2021. What was happening with interest rates during that period? They were near zero. It was incredibly cheap to borrow money. And when interest rates are low, the price of bonds go up. But now the price of this bond ETF is lower because interest rates have risen. For our second example, let's look at the TLT bond ETF. This fund includes U.S. Treasury bonds with maturities of 20 years and longer. Since it focuses on long-term bonds, it is more sensitive to the interest rate changes that we were talking about. This means its prices can fluctuate more than ETFs holding shorter-term bonds. Access to the long-term bond market will likely be more appealing to investors who want exposure to different opportunities and risks, but still desire the security of government backing. The expense ratio for TLT is 0.15% and it has an average yield of 4.47%. Next one, let's talk about the IBTG bond ETF. This one has a specific finish line set for December of 2026. Therefore, all the bonds this fund owns will mature between January and December of 2026. After that, the ETF will wrap up and distribute the money back to the shareholders. This type of ETF with a set end date could be appealing to investors who have specific life goals to achieve in 2026. It is actually a great example of how you can plan for financial needs at a specific future date using a conservative investment strategy. The average yield to maturity for IBTG is 4.36% and its expense ratio is 0.07%. Woo, I feel like that was a lot and we were just scratching the surface learning some basics. But if you would like to go more in depth on one of the topics covered, let me know in the comments below. Thanks for watching and catch you next time. Bye.